Modern Investing Techniques, Episode 4, Midweek Check-In, March 25th, 2026. Target length, approximately 2,350 words, approx 15 to 16 minutes. Midweek Check-In, everyone. Welcome back to Modern Investing Techniques, Episode 4, coming to you on Wednesday, March 25th, 2026. I'm Patrick, broadcasting from a very gray and rainy Vancouver this morning. Midweek episodes are some of my favorites because they force us to slow down, reassess the positions we discussed on Monday, and hunt for fresh, high-conviction setups instead of forcing trades just to stay active. That discipline, knowing when not to trade, is one of the biggest edges retail investors can develop, especially inside Canadian tax-advantaged accounts. Before we dive in, the standard but important disclaimer. Everything we discuss on this show is for educational and entertainment purposes only. The practice investment of the day is 100% simulated. No real money is ever put to work. I am not a licensed financial advisor, and nothing you hear constitutes financial, tax, or investment advice. Always do your own due diligence and consult a qualified professional before making any decisions with your capital. Past performance does not predict future results. Markets involve risk of loss. Let's start with the market pulse. North American equity markets opened the day with solid gains as reports of a potential off-ramp with Iran helped ease geopolitical tension that had been weighing on sentiment for the past couple of weeks. That de-escalation narrative gave investors permission to rotate back into risk assets, and the tape responded accordingly. The S&P 500 closed the session at 6,610, posting a respectable gain of 0.8%. The Nasdaq Composite outperformed slightly, finishing at 22,016 and climbing 1.2% on the day, driven largely by continued strength in technology and growth-oriented names. Up here in Canada, the TSX Composite was the best performer of the major benchmarks, advancing 1.4% to close at 32,388. Oil prices dropped sharply on the reduced geopolitical premium, while broader risk appetite lifted equities across almost every sector. For Canadian investors, today's action carries two practical implications. First, we need to keep monitoring the accelerating consolidation trend inside the renewable power space. Second, we should stay alert to upcoming domestic tax and benefit changes that will affect 2026 contribution limits, TFSA room, and RRSP planning strategies. While the broader market was celebrating reduced tension, one Canadian renewable energy name just received a very different and much more concrete vote of confidence. Brookfield Asset Management and La Caisse de dépôt et placement du Québec announced they will acquire all outstanding shares of Boralex Incorporated at $37.25 per share in an all-cash deal. This is a textbook Canadian M&A premium play, and it deserves a much deeper look because these situations appear several times a year and can deliver clean, time-bound returns when executed properly. Let me give you some context. Boralex has been a public company for many years, operating a portfolio of wind, solar, and hydroelectric assets primarily in Canada, France, and the United States. It has always traded at something of a conglomerate discount because its assets are spread across jurisdictions with different regulatory regimes and power contracts. Brookfield and La Caisse, two of the most sophisticated and best capitalized infrastructure investors in the world, clearly see an opportunity to take the company private, optimize the capital structure, and perhaps accelerate development of the development pipeline without the short-term pressure of quarterly public reporting. When a well-capitalized buyer offers a clear, fixed cash premium to take a public company private, retail investors suddenly have access to a high-conviction, time-bound opportunity that used to be reserved for event-driven hedge funds. The strategy is straightforward in concept, but requires precision in execution. You look to buy the target after a definitive agreement has been announced, but before the shareholder vote and ultimate closing. By doing so, you capture the spread between the current trading price and the offer price. As long as the deal closes, time decay actually works in your favor because every day that passes brings you closer to receiving the fixed cash consideration. Today's announcement for Boralex illustrates the setup almost perfectly. The deal provides shareholders who tender a clean exit at a fixed price, effectively removing equity market volatility and sector-specific risks for the holding period. To implement this strategy in your own account, start by using your broker's screener or a free tool like FinViz or TradingView to filter for announced all-cash takeover offers that carry premiums typically between 20 and 40%. That range tends to balance attractive return with reasonable probability of completion. Next, note the expected closing date. Most Canadian and cross-border deals close between 3 and 9 months after announcement. You can then calculate a rough annualized spread return using this simple formula: offer price minus current trading price, divided by current trading price, divided by the number of months to expected close multiplied by 12. This gives you an annualized percentage that you can compare against other opportunities in your pipeline. Of course, you must monitor regulatory approvals closely. Competition Bureau in Canada, CFI US if there are US assets, and any foreign investment reviews in Europe. Pay special attention to material adverse change clauses because a sharp deterioration in power prices or a major contract loss could theoretically give the buyers an out. Historically, this strategy has performed best in stable or falling interest rate environments when the buyers have bulletproof balance sheets. Risks include deal break fees that might not fully compensate you, regulatory blocks that come out of left field, or, more rarely, a superior competing bid that emerges late in the process. Position sizing is critical. I never allocate more than 3 to 5% of the overall portfolio to any single event-driven situation. That keeps the risk contained if something unexpected happens. This Boralex deal is a textbook example, but executing it well requires understanding the hidden costs that can quietly erode your edge, especially inside a TFSA or RRSP, where every basis point of slippage compounds over decades. Imagine you saw the Boralex headline this morning, got excited, jumped into your TFSA, and placed a market order for BLX at about 10:05 a.m. Eastern. Your order filled at $36.80, roughly 8 cents above the previous last trade. On the surface, that doesn't sound terrible, but let's unpack what actually happened. The sudden surge in volume after the announcement widened the bid-ask spread from its normal 3 to 5 cent range to 12 to 18 cents in the first 45 minutes of trading. On lower liquidity Canadian names like Boralex, that spread can quietly represent 0.3 to 0.5% of the share price during event-driven spikes. Professional traders avoid this trap by using limit orders placed thoughtfully between the bid and ask, or they simply wait for the first 30 minutes of volatility to subside before committing capital. A practical habit I developed after losing money on exactly this kind of situation early in my investing journey. Always check today's volume against the 20-day average daily volume before you trade any headline name. When today's volume is running 4 to 5 times the 20-day average, you should expect wider spreads and more expensive slippage. The single biggest mistake I see retail investors make, and I made it myself, is hitting the market order button on news-driven names. Instead, use limit orders exclusively and watch the level 2 tape for the first 15 to 20 minutes to gauge true liquidity. This one habit can save you 0.2 to 0.6% per trade. Inside a TFSA or RRSP, that seemingly small edge compounds into meaningful dollars over a decade. Knowing when and how to enter is critical, but equally important is knowing when not to enter at all, because 1. You're applying a disciplined dual criteria screen. There is no weekly hold pick for you today. This is not a failure of the process, it is the process. Our simulated practice investment of the day remains in cash. This is, of course, a simulated trade for educational purposes only with no real money involved. The AI analysis engine reviewed multiple corporate announcements that crossed the wire today, but none yet satisfy the dual requirement of both a clear fundamental catalyst and technical confirmation on the chart. We continue to monitor several gold exploration names that have reported recent drill results and closed financings, but we are not rushing in. The screen we use looks for 2 things simultaneously: an RSI 14 reading below 40 on the daily chart, combined with today's volume coming in at greater than 1.5 times the 20-day average. That combination has historically been a reasonable filter for setups that carry asymmetric upside with defined risk. Risk assessment in this case is straightforward: no position equals 0 risk. If a setup eventually meets criteria, we would enter with no more than 2% of portfolio risk and a stop loss placed 8 to 10% below entry on a weekly hold basis. Until then, the target price remains not applicable. My confidence level on any of the names we're watching sits at low. A single factor setup without technical confirmation simply does not meet the threshold for a high probability weekly hold. And that's okay. Patience is probably the most undertaught skill in modern investing. By walking you through the exact criteria we require, strong catalyst plus technical alignment plus volume confirmation, I want listeners to internalize that saying no to marginal setups is exactly how consistent outperformance is built over time. Next Monday, we will be back with a fully qualified weekly hold using this same disciplined framework. While we wait for those high conviction setups, there are several interesting developments in the institutional research and healthcare AI space worth keeping on your radar. First, Aduro Clean Technologies, trading on NASDAQ under the ticker ADUR, has engaged Water Tower Research to provide comprehensive research coverage and strategic investor engagement services. For individual investors, this is meaningful. You will soon be able to access the resulting reports directly on the Water Tower Research website or through most major financial terminals. This gives retail investors access to the same style of deep dive institutional quality analysis that used to be locked behind paywalls or sold only to hedge funds. It will be particularly useful to determine whether Aduro's growth narrative around chemical recycling of waste plastics holds up under rigorous scrutiny. These reports are typically posted within a few weeks of engagement, so keep an eye on their site. In the healthcare AI space, Netramark announced a collaboration with Fondazione per la Medicina Personalizzata to apply its proprietary Netra AI platform to a landmark Phase 2 oncology dataset. While the tool itself is aimed primarily at pharmaceutical companies, the underlying technique uses advanced AI to uncover hidden patient subgroups that traditional statistical methods often miss. For individual investors, this is a reminder to examine whether AI-driven precision medicine companies are beginning to gain real traction with large, credible research partners. Early validation of these platforms has historically preceded meaningful re-ratings in healthcare subsectors. Staying on the theme of smart capital deployment, two timely developments in Canadian infrastructure and housing policy dropped today that could have multi-quarter implications. Ontario and the federal government announced they will temporarily allow every buyer, not just first-time purchasers, to claim up to $130,000 in HST rebate on new homes for the next 12 months. This dramatically widens the pool of potential buyers and should provide visible support for homebuilder equities and related real estate service companies in Canada's most populous province over the coming year. On the infrastructure side, Aecon Group's joint venture has finalized a major contract worth US $691 million with the U.S. Army Corps of Engineers for work in Washington state. The win adds meaningful visibility to Aecon's backlog and underscores the continued strength in North American infrastructure spending. Canadian investors can access this theme through several TSX-listed construction, engineering, and materials names. Finally, Sky Harbor Resources strengthened its board by appointing Rob Chang, former head of metals and mining research at Cantor Fitzgerald and a widely respected uranium analyst, as an independent director. The move brings both governance credibility and genuine sector expertise at a time when uranium fundamentals remain constructive. A timely reminder as we head into the second half of the week. The majority of typical Canadian investors have access to TFSA, RRSP, or other registered accounts that can completely shelter capital gains and dividends when used correctly. With new 2026 contribution limits and benefit changes on the horizon, taking 30 minutes this weekend to review your registered account strategy is time well spent. Our Simulus Aided portfolio currently sits with no open weekly hold this week after sticking to the screening criteria. The running win rate across all previous simulated trades reflects careful filtering rather than chasing every headline. The AI analysis approach continues to learn from patterns where catalyst strength failed to align with technical confirmation, and it keeps adjusting the threshold for entry to protect the simulated capital. Before we wrap up, one last practical takeaway from today's Boralex discussion. In takeover situations, the initial surge of enthusiasm often creates exactly the kind of liquidity trap that quietly eats into your TFSA or RRSP returns. You see the ticker jump, the spread blows out, and that market order suddenly feels 8 cents worse than the last printed trade. Checking volume against the 20-day average gives you an immediate warning signal. The fix is simple but requires discipline. Wait for the first 30 minutes, use limit orders, and watch the tape. That single habit can save 0.2 to 0.6% per trade, dollars that compound tax-free for decades. Watch for any updates on regulatory timelines for the Boralex transaction and continued strength in infrastructure and construction names. That's Mo. Darn investing techniques for this Wednesday. If you found today's deeper dive useful, please share the episode with a fellow investor and subscribe wherever you listen. Check the resources page on the website for the tools and platforms we reference. We're back tomorrow with fresh analysis. Until then, keep learning, keep refining your process, and keep investing with discipline. This expanded version gives each story the breathing room it needs, 6 to 8 sentences. adds meaningful context and personal takeaways, creates natural transitions, and maintains the educational yet conversational tone without introducing any new stories. This podcast is curated by Patrick but generated using AI voice synthesis of my voice using ElevenLabs. The primary reason to do this is I unfortunately don't have the time to be consistent with generating all the content and wanted to focus on creating consistent and regular episodes for all the themes that I enjoy, and I hope others do as well.